Hello, my name is Steffen Pauls and I'm the CEO and founder of Moonfare. Welcome to our Moonfare Deal Talk session today. In this series, I interview some of the globally leading deal makers in private equity. Today is a special day and a special edition, and it's great, and I'm really excited to have Christian Sinding with me here today, who is not only a friend of the firm, personal friend, but also a fantastic private equity investor, and even more importantly, a great entrepreneur. Christian Sinding is the CEO of EQT, the Swedish private equity powerhouse. Christian has been leading the company through a period of incredible growth. Today, EQT manages companies and assets worth more than 230 billion euros. It made more than 2 billion euro in revenue last year and has close to 1,000 employees across the globe. Christian, this is truly an incredibly impressive success story. Very, very happy to have you with us today.
It's great to be here, Steffen. I look forward to our conversation.
Yeah, Christian, let's start with some personal background about you. You were born in Oslo, but you spent quite a bit of time in the US, and then you joined EQT, a Swedish firm, in 1998. Someone in the Financial Times I read once described you as having a cerebral side of Scandinavian and the heart element of an American. Do you also feel that you got the best of both worlds?
Yeah, that's an interesting way to put it. We Scandinavians like to think of ourselves as having big ears and a small mouth. So we're pretty good at engaging with people and listening, and you need to do that coming from a small country to engage with the world, because your home market is too small. And for me personally, I think that kind of curiosity that comes with that approach has helped me a lot. And then I think the forward motion that the Americans have, I've brought with me as well somehow. So I am kind of a product of both worlds. And my wife is also American, so I live in this duality also at home. And I think it's been good for me as a leader of a now global organization, actually.
Look, talking about Europe and the US, there has been, it is still a lot of talk about Europe really falling behind. And in particular, when you talk also, to people in France, in the UK, and in other countries in Europe, but also in the US, there's a strong concern, frankly, about Germany, where I'm coming from and where Moonfare is based. Look, the roots of EQT obviously are in Europe. Europe still is a major focus of your investment world. What do you think about, David Rubinstein, for instance, founder of Carlyle, whom I interviewed more recently in a deal talk? He said, look, Europe has not, any game-changing technology produced since years. It's falling behind economically. I just read recently, in the OECD report, the country, the Western Hemisphere that is working the least is actually Germany, with an average of 25 hours a week. Productivity potential, which is an indicator for future GDP growth, is at best at 0.5%. So what do you think about it? Would you agree or that Europe is falling behind? And B, what is your view on the future then for Europe?
Yeah, I think this is an important discussion. I don't agree, at least not when you look at all of society. So if you look at, for example, drug discovery, there's more drug discoveries, there's more patents being filed in Europe than in the US. Same with organic chemistry. In fact, a lot of research, a lot of academic papers, a lot of basic research is developed in Europe. We're on the forefront of sustainability technologies, the move to net zero, and I think from a societal point of view, I think there are many benefits to the way that many European countries are managed, which creates more equality, and therefore, many European countries, particularly from the north, are actually ranked in the world as the happiest societies in the world. Norway, where I'm from, Finland, etc. Having said that, on the tech side, I have to agree with David. We are falling behind, and I think it's not just the innovation side, but it's also the way that companies are developed and how capital is raised and where those companies end up. So Europe is very fragmented in its capital markets too. So it's much harder to bring a company from a small innovative base to become a global leader. That's much easier in the US with, particularly Silicon Valley and other areas. So that is a challenge. Macron and others are working on it. We're involved in that, in improving Europe's competitiveness. And I think it's important for the future.
Couldn't agree more, Christian, and it's so much needed. I just read in the Financial Times very recently, Christoph Schweitzer, CEO of BCG Worldwide, he said that generative AI and associated consulting projects stand already for 20% of BCG's global turnover.
Yeah.
And if you think about it, what that means in terms of the importance of here, in this case, AI and technology in general, you just cannot afford to fall behind even more. So hopefully we see some catch up in the future.
I agree.
Look, let's talk a little bit about your more recent, it feels probably like an eternity for you, but more recent role as a CEO. You started as a terrific deal maker in private equity. People know, and we could talk endlessly about your deals. But I want to talk about your time now as a CEO. And in these turbulent times, and the economic things we talked about is just one aspect. There are many more, of course. What do you see as your biggest challenge currently as a CEO after these incredible successes you had with the IPO, the share price development? We will talk about more recent, exits in your portfolio. What are your challenges, and what are your currently or have been your most difficult decisions you had to take?
Yeah, yeah, these are important questions. We're now actually 1,850 people around the world. So we're in 22 countries. We're top 3 in private equity in the world. We're on our way to probably becoming the biggest. We can come back to why a little bit later, why I believe that. We're one of the biggest in infrastructure. We're building a nice real estate business as well. And we've quadrupled our size in less than 5 years, since we went public. And that's in every dimension, in AUM, in profitability, in a number of people. And that means that you need to organize yourself differently, and as companies grow, they tend to become more bureaucratic, right? And you get more hierarchy, you get less information flow, and you become more corporate, if I want to use that simple word. And so that's probably one of the biggest challenges. How do we keep this special sauce that EQT has, our values, our culture, our deal-making ethos, while we're continuing to grow? Because our growth path actually will continue for I think, another generation or more. And we're set up for that. So we do a lot, I do a lot, and we as leaders of the firm, the various partners around the world, we take on a lot of responsibility to keep that small company spirit, to keep moving forward, to try new things, to fail, to innovate. And if it doesn't work, you stop doing it. If it does work, then you roll it out across the firm. And try to keep it fun. It's been a lot of fun building this business, just like you're doing with Moonfare. And it should still be fun, even though the company is a lot bigger. So I think that's the biggest challenge, is not turning into a big corporate, actually. And that's not gonna bring the right people into EQT either. You know what I mean? So that's a really interesting psychological elements that just kind of creep in. And it reminds me of one thing before you take over. We have an industrial advisor named Ulf Berg, who's kind of half Scandinavian, half German. And he says, bureaucracy is like fingernails. They need to constantly be trimmed. And that's something I'm trying to apply internally, is that, as soon as we see bureaucracy coming in, we really try to nail it. Also to make a point that we actually have the power to, we're running our own firm, so we can decide how we want our culture and values to be, and we're in control. It's not some invisible force taking over,
Yeah, look, let me double down on this one. As you know, Chris, I've been part of KKR when KKR went public back in 2008 or 2007 or so, so quite a while ago.
Mm.
And KKR, and also when you talk to Henry and others in the firm, has changed quite a lot. I'm not saying to the worse or to the better, but it has changed quite a lot. What would you say about EQT? Is it now, since you are public, is it a better business because it's listed? Does it have more chances? You mentioned 4x growth in all dimensions. And what's different compared to your private days?
Yeah, I think, and there are some real benefits, and then there are a couple of challenges that come with it. But the first thing we did when we decided to go public was to say that this is not impacting who we are as a firm. It's a capital structure decision in a sense, right? We needed a balance sheet to continue to grow and support the firm, to start new businesses. We wanted a currency so that we could do M&A, which we've done, and combined other firms with EQT and have a currency to pay with. We wanted to strengthen our brand globally. Now with Moonfare and others, it's much more of a retail-oriented business over time. And then we needed a kick in the butt to actually get our back office, if you want to call that, all of our administrative processes really humming and modernized. And going public actually put a lot of pressure on us to do that. Now we have a great COO who's super at that. So all those things were actually real benefits that have helped propel us into the position that we now have. The downside, of course, is that the public markets, if you let them pressure you into going a certain direction because that's the flavor of the day, you can get a little bit distracted from actually what you want. And what you want to do with your business is deliver for your clients. You want to be the best possible provider of, for us, returns to our clients in a responsible way. And if you let being public or any other kind of ownership get in the way of that, then that becomes a problem. So that's something that we work a lot on. So when you walk around EQT, you won't see any ticker tapes. We don't talk about the stock price. We talk about it in the sense that we want to deliver great returns to our investors. We want to use that trust that they have in us to build a great business. And at some point in time, the shareholders will be happy. But keeping that North Star with all the interest that comes with being a public company, with the press, with the analysts, with shareholders, with the transparency, is something that we are trying to embed in our DNA, actually.
Yeah, and I guess it's supported by the fact that you and other senior executives in the firm still own a substantial portion of the company.
Yeah.
So it's not an anonymous thing for you.
Mm-mm.
Look, huge congratulations, by the way, on the more recent news when it comes to exiting companies in your portfolio. There was this incredible, I would say really incredible, astonishing IPO of Galderma. Galderma is a former division of Nestle. And it went public, I think, end of March or so on the Zurich Stock Exchange. It was one of the biggest, by the way, IPOs globally. This year, certainly the largest in Switzerland since years anyway, but also, of course, in Europe. And a huge success for you and the shareholders. So I know you were planning this IPO and talked to Markus Brenneck and others about it.
Yeah.
He told me that was in the making. But what made you make the decision really now? What were you seeing in the public markets? It was not an obvious one for me to go public now.
Yeah. Galderma is a fascinating story. I think we've been prepared to go public for almost 2 years, actually. And that's what we're trying to do with all of our companies systematically, is prepare for the exit much earlier, get management ready, get the equity story ready, get the numbers ready, all these kinds of things that you need to do to prepare companies for exit, in particular if it's an IPO, which we thought Galderma has all the qualities of a great public company, the size, the future growth, all that kind of stuff. But the market conditions have been very difficult. And then we want companies to have a great start when they go public. And typically a great start actually means that it continues to be very good because the shareholders are happy in the beginning, the management gets confidence, and you have kind of this positive momentum with you. So we decided to go now in March because we felt that the stars were aligned enough And we actually also were, talking to our bankers and a number of investors that we've been engaging with over time, that Galderma also has the qualities of what people appreciate in today's capital markets: an understandable business model, long-term growth, great management, et cetera, and the size to create liquidity. So it's interesting. So we actually had a real responsibility there of trying to help reopen the equity markets. And we then ultimately it's just a decision that you take. The stars are never perfectly, like this. So, but they were tending in the right direction. Capital markets were okay. Interest rates were stabilizing. Yes, there's geopolitical unrest, but it seems like that's something that's going to continue for some time across the world, unfortunately. So we went for it, and I think what we decided to do then is to make sure that we prepared, even in the shorter time frame, engaged even more with the investors. We priced it in a way which was balanced. I think is also helpful, and because we're going to be long-term shareholders of this company for several more years, and we really said that. More strategically, actually, we also had a discussion around we want to be the best we can at delivering IPOs to the market globally. We own so many companies. We have so many companies that are going to go public. We need to have the skill set to be able to take those decisions. And we use this as a test case. And I think we did a lot of things right. And whatever we did, we're going to replicate. That was good. And the things that we didn't do right, hopefully we can do even better next time. But this case was almost perfect.
Look, the past year was a very, very difficult year for the private equity industry in general, but also for the LPs, because the lack of distributions really made their lives in many cases far more difficult. And this is why DPI is the new IRR.
Yes.
DPI counts more than ever now. And you did something I find very interesting, innovative. You took an innovative approach by developing or defining a new exit strategy, the so-called private stock sale, where you intend to sell portfolio companies from equity in your portfolio to your existing investor base instead of doing a typical IPO. I think it's a fascinating idea. And I would be interested, how did you come up with it? Does it work? Is there demand?
Yeah.
And do you foresee other innovative ways how funds can sell their portfolios in the future if there is, a lack of M&A activity or if the IPO path is closed?
Yeah, this is a super important question and field. So it came actually a little bit from frustration. IPO markets opening and closing all the time. A year ago we were ready to take Galderma public, and the bankers just said, sorry, there's just not enough demand. It's too big. Can't do it. Which is crazy when the public markets are 120 trillion and we can't take a $20 billion company public. It didn't make any sense to us. Like, this doesn't, why? There's some reasons for that. More than half of the market is owned by index funds and ETFs. They're not allowed to buy IPOs. The long onlys are careful. 93% of managers underperform the index, so they're very careful. And then you have the hedge funds who are buying IPOs, but they want a good deal. So the IPO market is complicated and not great in any sense. So we said, how do we deal with that? Well, we want to make sure we have companies that we can sell to industrial buyers, to families, to financial groups, and take public. But isn't there another space here where we say that we if we want to continue to own the company, management wants to continue to be private and work with us. We see a long-term growth runway, lots of M&A, growth, development, whatever. But we need to create liquidity in the fund. Why don't we keep the company and make a market in the equity, but privately? So and we have 1,200 LPs today, a little bit more even, and growing. And there are a number of institutional investors, of course, that are also not investors with EQT. We could make a market either with our own LPs or with others. You need to find a way to set a price, probably with a third party, just like you do in the public markets. And in a typical IPO, you have maybe 150 investors, right? We have 1,200 just with EQT. Why couldn't we just replicate the public markets, but keep it private? And then we can make that market once a year or every other year or whatever. And if you draw it to its final conclusion, you could actually end up with a company that has enough shareholders that you can just list the business. You don't need to go through the IPO process. So you don't need to create that demand that I said, with Galderma wasn't there when the market was weak because we don't need to raise any capital. You just list it like Spotify did on the New York Stock Exchange, for example. So we're working a lot with this right now. Hopefully we'll execute on the first one this year. And it kind of connects to continuation vehicles, co-investments, secondaries, that whole space of solutions and liquidity in private markets, and something we're putting a lot of resources behind. It's quite fun, and I think it's going to happen, and a lot of different people are talking about it. And I can tell you, like every investment bank and every big LP that we've engaged with, either we called them or they called us, and it's creating some excitement. I think a new path forward.
Look, definitely, Chris, and this is so important because if you put it in an even broader context, the private markets are private and companies stay private for much longer. That's happening on the tech side. It's happening as we speak. With AI companies, there will not be what we have seen, the Googles and Facebooks, now Metas and others going public a couple of years after inception. OpenAI is rumored to be, in an incredible range of valuation already. It is still private. It's going to stay private. And now think about, number of IPOs going down actually in the US, taking data. Take the numbers that are privately held of companies in the US, 9 times larger than any public companies. So the opportunity set in private markets is already enormous, and it becomes even more enormous by the new strategies that you just pointed out, alluded to. Look, you have been successful in many dimensions, and for you, I guess 2023 was a year to celebrate again, because on the fundraising side, you closed the largest ever buyout fund, EQT buyout fund ever, with 22 billion or so euros in your history. And as you know, Moonfare has been part of it. Was a great fundraise. Clearly an incredible product, and testament that people see an enormous potential still in private equity in the mid to long term. Look, but your business now is so much bigger, and the entire industry has grown so incredibly over the past 10 years, of course, partially driven by low interest rates, which makes, defining and be clear and consequent about your competitive edge even more important. So what is, or how would you describe EQT's edge? What makes you different, and what also, keeps this different up in light of that you have, what is it, doubled or close to doubled the size of your flagship private equity product?
Mm-hmm. Yeah, we are crystal clear on what we want to continue to do, and that's we want to become the global leader in active ownership strategies. And what we mean by that is that every strategy that we have, any investment strategy that we have, we are making an impact on the companies or buildings that we're working with. So whether that's in venture capital or in life sciences or in growth or private equity infrastructure, we are either as a minority owner or as a majority owner, we want to engage, we want to help future-proof the company, drive it forward, help drive transformation. And we think that's actually fundamental value creation is what it comes back to. We've never been financial engineers at EQT. We've never relied on leverage for our returns. We're never the ones that have used the most leverage either, and neither in our portfolio companies nor in the funds or anything like that. We think that where you actually make consistent long-term returns by making companies better, stronger, faster, bigger, more international, more innovative, more sustainable, whatever. So we put all of our resources behind building, tools for deal teams, for boards, for management teams to build their companies better and better and better. And with the same philosophy also in real estate, where we actually have an integrated model where we have people, working on the ground with all of our buildings, et cetera. And that philosophy, I think, means that we don't have an AUM goal at EQT. All of our competitors have AUM goals, But the AUM is actually a result of us delivering performance for our clients. And we think that performance, particularly now, if you're going, now for the last 10 plus years, everybody's been benefiting from, multiples going up, interest rates going down. It's been pretty easy for everybody, right? Now it's getting hard. And it's going to get hard to create value in the same way. It's also going to be much harder to fundraise, which we're seeing now in the market, because the investors are used to getting 2 times the money back after a few years and then reinvesting into a bigger fund. Now it's turned on its head. Now they get half the money back. And that means that they have to be much more selective with who they partner with. And they're going to partner with those firms that believe that where they believe that these guys are going to be able to drive the best risk adjusted returns for the long term. So it comes back to really fundamentally delivering for our clients. And we do that by building better companies. And that's what we burn for every single day.
Yeah, look, it's reflected in the data. If you see your success, but also take CVC, take other of the large players that also pursue an active ownership approach in deal making, they are seeing inflows.
Mm-hmm.
Yeah, and call it stuck in the middle player who were still strong, in the past 10 years, but have no recipe to create alpha. Are falling behind, yeah, and then you have specialists that basically do information arbitrage, yeah, very local players, in the small cap, size that still have a reason for being. But I can clearly get this. One thing, what you said is, and what sets EQT apart is your famous Troika model.
Mm-hmm.
Yeah, it's a very interesting governance model. I think, as far as I know, you are the only ones applying it, and this is basically, a model where you bring together, an external chairman, the CEO, and then the person as most senior person in the deal team who has made the deal. Could you describe to us, to the audience, how the system works and why you believe it's superior, and maybe also some cons against it?
Mm-hmm. Yeah, it's really at the core of our governance model, and we have a very traditional governance model in one sense. We represent the owners. We staff the boards of the companies with the most talented people that we can from the outside world. Of course, also some people from EQT. The chairperson is always a specialist from the industry. So if it's in healthcare, for example, we might have the ex-CEO of Johnson & Johnson there, or whatever it may be. And then the board is responsible for coaching and challenging management to execute, on the value creation plan. But we realize that model is very clear, but it's missing something. It's missing the speed, the entrepreneurialism, the flexibility of being so close to your businesses as we are. So we created this troika to basically be the grease in the system, where you align, the owner, us, the chair of the board, and the CEO in kind of cleaning up all the noise. So when you come to the board meetings are about moving forward, about driving, doing an M&A deal, or investing in a new product, or driving change in some division, or whatever it might be. And it's very energizing too. And it gives, ultimately, it's kind of like it's a mentoring ground and a resource for the CEO, so that he or she can actually execute faster and know that they have the backing of the main constituents. And then this comes together with a lot of information that's provided, of course, continuously to the board. We try to handle a lot of the administration as well, so that the board meetings they're all about strategy, and not about all the other stuff, the formalities and all these things that the boards need to do. Now, the con is that if the troika is too powerful, then you basically overrule the board. Everything's done before you get to the board. So it needs some discipline, that it's actually the grease in the system. It's not the system. And that means that it needs to be managed very well by, and typically it's the chairperson who manages that. Depends a little bit on the dynamic, but that's a key one, because if we don't believe that such a small unit is the right one to get to the best decisions on the most strategic questions, then you really want the board to be fully engaged. So that's the downside of the model and something we manage.
Christian, Stephen Schwarzman once said, "We do see things that others don't." And you seem to see things also that others don't see, because you've made headlines in our industry when you said, not a long while ago, that offloading your credit business, and credit is the talk in town, as you know, was one of the best decisions EQT has ever made.
Mm.
It goes very much against what many firms are believing. I said it's talk in town, it's en vogue. Many credit funds search. Huge demand because of lack of alternative debt financing. What is and what was the rationale behind your thinking around credit? What are you seeing what others don't?
Yeah, it was a pretty easy decision for us, interestingly enough. And if you think about what I just talked about, what do we burn for? What are we good at? It's owning and adding value to companies, and it's engaging and having an impact, and it's making a difference, driving strategy, integrating sustainability into our companies, driving to net zero or whatever it might be, and all that you can do as an owner. As a credit provider, you're one step removed. You're passive, and you hope that one day that you'll get your money back. And you'll get that with interest, and that's just not something that we were the best. We weren't the best owner of that business, actually. There were really good people in it, and they were reasonably successful, but it kind of defocused us on exactly what I talked about. And when we sold the credit business, we created this matrix of how do you combine all the skill sets of EQT with the active ownership. And of course, all the other businesses were up in the top right-hand corner and credit was down here. So when we sold that, then we actually had we got the capacity, intellectually, management-wise, et cetera, to go and expand more. So that's, we talked about the super fast growth. One of the reasons is that we let that go, focus on active ownership. And then we said, okay, good. Now we need to grow in real estate. So we brought in Exeter. We need to become one of the bigger players in Asia. So we merged in BPA. We need to get smarter in life sciences. We have our own tech venture fund, but we don't have life sciences. We're a huge healthcare investor. What do? Okay, well, let's bring in Europe's leading life sciences partner, which is actually called LSP, Life Sciences Partners. So that enabled us to make much clearer strategic decisions. So for me as a CEO, that's why it was one of the best decisions, because it just cleared the mind. And then we try. You'll recognize this. We tried to think. We put the private equity lens on ourselves. If we were a portfolio company, what would you do? Oh, and the final dimension is that our other businesses, we have a path to becoming top 3 in the world or whatever. In credit, we were number 47 in the world, and we didn't have a path to win either. So that's why it was such a simple decision, even though it was strange. And of course, since then, every banker and every consultant has knocked on our door to tell us to get back into the business. But then I tell this story, and then they shut up.
Terrific. Look, Christian, when you ask my team, when you ask me, why are you doing at Moonfare what you're doing, this democratization thing, the answer really of my team is because they believe in what we are doing has a positive impact on society, on the world. By giving people access, we create more prosperity for all. And that's a huge driver. And I believe, in a way, you at EQT, you share these values. This is why I want to talk about infrastructure, because I know it's a major theme for you, and it's a major theme for society. You're just, we're raising your 6th infra fund, and you're on track to reach your 20 billion target. And I believe infrastructure is really a great way private equity can have impact. Can address some of the global challenges like the energy transition, healthcare needs, and other infrastructural needs that are out there. What opportunities do you see specifically?
Yeah, I think I come from the buyout side, so everybody thinks I'm always biased towards buyouts. But if I have any bias, it's kind of leaning towards infrastructure for exactly the reason that you described. The companies that we're buying in that space are providing essential services to society. They're helping transform society. I'll come back to that in a second. And if you apply the private equity mindset and tool set to the businesses, you can actually generate real upside financially as well. So it's a pretty unique business model actually, and there's a lot less competition, fewer players than on the private equity side. So it is something which is very exciting, and the companies often need capital to grow. So you actually can put capital to work in the businesses organically, which is also quite stimulating. What we're excited about is how society, the changing nature of society these days, the digitalization of society, which is now, of course, massively accelerating again with AI. So data centers and fiber, broadband, and all those things related to digitalization of the world is accelerating. So we're investing a lot behind that. The energy transition is huge. So the energy systems themselves, but then also transportation. So we own the largest ferry network in the world, which was started in Norway, and it's really not about owning ferries. It's really about decarbonizing the entire ferry fleet. So you basically become an electrical bridge that's totally quiet, totally neutral to the environment, super nice in the Norwegian fjords or wherever you are. And we're also building the first hydrogen-based ferry in the world to drive new technology into that space. We're doing the same with yellow school buses in the United States, et cetera, et cetera. So the transportation systems need to change from fossil to electric. Even if you don't believe in climate change, you still need to, because you're going to run out of fossil fuels at some point in time, right? So that's really exciting. And then you have the next dimension is also the changing nature of manufacturing. The whole world of manufacturing needs to also move from fossil fuel energies to electrical energies, which means a lot of the grids need to change and all kinds of other things related to it. So behind that, just the energy transition alone is something like $275 trillion is the most recent number that I've seen. So it's incredibly large. It's kind of a once in a lifetime opportunity. And we're doing that in our larger infra strategy. But we're also going to be launching another strategy, which is a transition strategy to drive that even more aggressively. So so there it's really about choosing the right opportunities because there are so many of them that we choose the right ones and we build the right companies. But it's really exciting.
Thanks a lot for these insights. Look, I talked and touched a little bit on democratization, and I want to get your views on this topic. As you know, this is a pretty recent trend. It's a secular trend. It's probably something that will be out there for the next 20 years. In Europe, we just have taken the next level of democratization by the so-called LTIF regime. Moonfare, of course, you have done similar products in the pipeline, has just launched our LTIF. It allows us now to give access to private equity with as little as 10,000 euros. It's a massive opening up of the market, super well diversified product. Yeah. So really a way for many people now to play and participate in private equity and really add it to their portfolios for better risk return profiles, etc. Look, I know that, and you mentioned it earlier, EQT early on has understood that this is a mega trend. You just, I read it in the news, hired a very senior person for the US market as well.
Right.
But more generally speaking, in what way do you think will private equity, the industry, need to adjust as more and more individuals and not institutions gain now access to these investments, whether it's in infra, whether it's in traditional buyout or tech, wherever?
Yeah, it's actually quite profound. We now have partners like you, which is great. We also have our own product, like you mentioned, EQT Nexus, and to provide those products to the retail investor, we need to be even more transparent. We need to report much faster than we have in the past to our institutional clients. We need to consider liquidity in a totally different way, because these products are semi-liquid, a lot of them, which means that you can buy and sell within certain limits every month or every quarter. And then you add another sort of strategic dimension around it. You also need to build a brand and to build a story that people can understand. And you're obviously doing this, so you understand it very well. But to communicate private equity in a simple way to the new investor is also something that our industry hasn't been particularly good at, because we're using a lot of our own lingo and ways of describing things, and nobody has heard of IRR or DPI or anything like that unless you're in our industry. So there are a lot of different levels of change that's happening, and but it's also quite fun, because why should only institutional investors be allowed to invest in this asset class, which continues to outperform other asset classes? It isn't equitable, actually.
Yeah, look, and you mentioned education, Chris. It's so important that you say this, because my biggest concern and fear is really, that people at the end up buying stuff that they don't understand. Yeah. And private equity is still, there is this semi-liquid, but it's still an illiquid product by nature. And this is where partially, at least, the outperformance is coming from. For me, it's so important that people understand that it's semi-liquid. It's not liquid, because people read semi-liquid as liquid. We have seen this with Blackstone in B-REIT and B-Credit in the US. So the education and the appropriate products, appropriate language, you said, is so important to get it right. And I can only recommend to everybody, as a private individual who wants to play private equity, go with the established firms that have been doing this for years. Don't jump on the next, kid around the block. Really trust, if you decide so, your money with players like EQT and others who have proven to be reliable, and very, very serious partners in the industry. This is so important. Look, let me talk a bit, and I'm a big, a person that believes in tradition. And, you have a very, very, as a firm, powerful background, being founded by the very prominent Wallenberg family, with many shapes, ways and forms shaped the economy in Sweden. How does these roots, this heritage, influence still your firm, your approach to investing, your culture?
Yeah, it's it's actually deeply embedded in who we are, because when we were founded, from the Wallenberg Group, with Connie and Thomas and the gang, it was really about, we took inspiration from the world of private equity, but we wanted to use the philosophy, the long-term ownership philosophy, building great companies as the Wallenbergs do. So we kind of combined the two, being great owners of businesses, but with the private equity toolbox, whatever you want to call it. And that's still at the core of EQT today, actually. We try to, we talked about governance. We try to have superb governance on our own company and all the companies we own. We want to think long-term, not short-term. We're really concerned about having superb people, superb cultures and values in the companies that we own, because we think that, high-performing organizations are really what help drive our companies forward. And so there's quite a lot. And I think that having a family backing us makes us also, as business people, have a bit more of a long-term mindset. And the stock exchanges, now that we're public, is very, very short-term. So it's another, another strength, actually, against that short-termism that sometimes permeates the world. So it's great that we have a great partnership with them, and they're still, they're our largest shareholder still, actually. Yeah.
Christian, let me personally please lean on your experience as a CEO. One of the things I find extremely challenging, and Moonfare is much smaller than EQT, but we are active now in 24 countries. We have 9 offices around the globe. We are in 3 continents. The fourth one will follow very soon. And we have 250 people and not 1,950 people. But it is extremely difficult for me to even with such a relatively small firm, to maintain our unique culture across the globe, a performance culture, a culture where we share the same values, where we communicate in a very similar way. We have at Moonfare we have 24 different nationalities, which doesn't make it easier, and a huge diversity. How, in light of this incredible growth that you have been through over the past year, how do you manage to maintain the culture?
Yeah, it's the perennial question, and we're 45 different nationalities at EQT. So it's ultra diverse in so many dimensions. So we actually we bring it back to the basics. We hire, we promote, develop, and also fire, actually, in accordance with our values. So even the day you join EQT, we actually have a game that we play. It's called Value Booster or something like that. It's been years since I played it myself, but you play the game as managing a private equity firm, and you have to solve problems, and those problems are not financial problems. They are cultural, they are interpersonal, they're leadership challenges, and so we start to build in our values, already at the beginning of when you're joining the firm. So when you look at the promotions even to the partner promotion, one of the main criteria is how is this person living and acting according to the values, and then we have different scales of evaluating that. And another way to say it is that if you're not working in line with our values, then you probably don't belong at the firm. You might be a great person in other dimensions, but doesn't really fit in here. So that doesn't mean that you can't be yourself, because that's also part of who we are. We really want people to be comfortable, to be happy, to be challenged, to be allowed and encouraged to speak up in any scenario, any situation. So we like to create psychological safety, but we think our values actually create the system that facilitates that. And then our culture, if you differentiate between values and culture, our values kind of stay unchanged no matter how large we are. But the culture, of course, develops. Versus when we were a small Scandinavian firm, now we're global. We have Japanese colleagues, we have Korean colleagues, we have American colleagues, we have Swiss colleagues, et cetera, et cetera. Of course, the culture of the firm becomes more international, more diverse, et cetera, which I think is great and a lot of fun as well. So it's really building the value set into everything that we do and being relentless about it. And then you feel a lot of responsibility for this at Moonfare, I know, and I feel the same too. But one of the things I try to do is make sure that all leaders, and not only leaders, actually everybody at EQT, it's everybody's responsibility to keep us as a great firm. It's not Steffen who's supposed to do that at Moonfare. It's the whole firm, right? So if you get everybody with you, that actually helps create that momentum that hopefully will keep it going. But this is really at the core. If you're successful at this, I think you can create also real scalability in your firm, right? Because you don't have to have a manual for everything. You kind of, that this is the way we do things, and then you can talk to people and go execute.
Look, this, Chris, I've been following EQT since 2004, so I have so many friends within the EQT family, and I can only confirm what you're saying. The type of personalities, how they talk about the firm, how they talk about investments, how they talk about values is very, very similar. And maybe a reason why I have so many friends there.
Yes, exactly.
Look, talking about you, is there any company out there, whether it's a private equity firm, a portfolio company, or someone else, whom you particularly or especially admire? And if so, what do you find fascinating about this or that firm?
Yeah. I'm not really the kind of admire. I'm not the one who looks to things to admire in that way. But maybe the way I would characterize it is that there's certain things I get inspired by, And some years ago, Netflix, for example, they have their leadership manifesto or whatever it's called. I can't remember, their values document or something like that. And that was amazing because they actually put into words in a much deeper way exactly how they manage their firm, their culture, their values, their incentive programs, and all that. So I was inspired by that, and it helped us. The systemization that I talked about, we've done that for a while, but it helped us, move that even further and faster. If you look at the challenge of being public, we use Apple as an example, or I use Apple as an example. Is who is Apple existing for? Are they listening to their shareholders, or are they listening to their clients? Why does everybody, why is Apple so profitable? Why do they have $1 billion in cash or whatever it is? Well, it's because they deliver incredible products for their clients. So we try to take some inspiration from there. And then we have, we might have some leaders in sustainability. Paul Pullman, for example, more as a person, not as a company, but he obviously drove a tremendous change at Unilever during his leadership there. And he inspired me to really work to integrate sustainability into everything that we do, not as a side project, but everything that we do and everything our companies do, to make them more prepared for the future and better places to work and better for society and all these things. So I'd rather say that I and we as a leadership team take some inspiration from here and there, because we're trying to also define our own path. We don't want to try to copy anybody else. We want to be EQT.
Couldn't agree more. Makes so much sense, Chris. Chris, look, before the interview, we typically ask our community to send in their questions, and we got many, by the way, relating to EQT and yourself. But there's one theme that repeatedly stood out, which is around value creation. We talked about value creation and active ownership earlier. And we also talked about or touched quickly in the surface on AI. And the question is around, whether AI will enable private equity companies to, so to say, take the next level in their value creation approach, and how will AI change value creation in EQT's portfolio companies?
Yeah, great question. And I'd say profoundly. And if you look at EQT, actually, when we started our venture business, venture capital business back in 2014 or so, when the team entered EQT, they looked at us and said, "Hey, why are you guys using all this old technology? We had Microsoft and VPNs and stuff. We should be in the cloud." So they went and created their own IT system over the weekend, the Google Suite, Dropbox, and Slack, and came back on Monday and said, "Hey, we've got our own setup here." And then we said, "Why shouldn't we have that kind of setup? That sounds pretty cool." So we threw out our old IT systems, went to the cloud. And then the second thing was, this started our AI effort. The old-fashioned way of doing venture capital at the time was to do a lot of research online and read publications and stuff, and then call founders. Of course, that's much smarter with a bot, right? With AI. So that started Motherbrain, and Motherbrain is now, 35 data scientists that are working in all different aspects of internally at EQT on how do we use data better? How do we find disruptive technologies, either to invest in or to avoid? How do we track decision making and the language around decision making to become smarter investors? Fascinating stuff, really interesting. So we're doing a lot of that internally, and have been for years. And with generative AI, of course, the capabilities have massively expanded because we spent a lot of resources building AI in the past. Now we're using AI almost solely, which is cool. But the big move, of course, is in our portfolio companies. So we have a program now where every single portfolio company has to take in and try to figure out what are the threats that are coming from AI, whether it's a new technology or a startup or somebody doing things faster or better or whatever it might be. And but what are the opportunities? And every single company has opportunities with AI, whatever it is, whether it's a consulting firm or a private equity firm or a manufacturing company or whatever. Machine learning is going to help you in multiple areas. so rather than just talking about it and a lot of people kind of testing it a little bit, it has to be integrated now into strategy and executed upon. And yes, you're going to make lots of mistakes, but we think that it's better to take a decision and try something and then pivot than to kind of wait and see what other competitors are doing, because the world is moving ultra fast. So this is a big push that we've had now for some time, and it just needs to be accelerated, because if you think about the importance of AI, it's probably as disruptive as the internet was, for example, right? Or the or whatever other dimension, or maybe the dimension of the smartphone. I mean, it's going to drive massive change in how companies execute, and of course, owning a lot of companies is key.
Christian, so true, because talking about AI, and I keep on talking to our team and people in private equity. In my view, it will be even more important than the internet. By the way, this is a Bill Gates quote, not from me. Mm-hmm. But the point here is the acceleration will be much faster. Mm-hmm. And why is it? Because now we have an established ecosystem of some of the largest companies in the planet. One of them, Microsoft, is pushing for it. One of them, Google, is threatened by AI in its core business. Mm-hmm. Multi-billion company. Yeah. The system is being floated by money. As we talk, hundreds of startups are emerging in the ecosystem. So there is, if people don't adapt to AI, they will lose. And ending up this discussion with my quote from the beginning from BCG, they expect to double 20% today, this year, 40% next year. The AI generated related projects globally, 40% of them will be AI related. So it tells you how quickly the industry in general or the economy is moving. Look, unfortunately, and time has been flying. It's terrible. No, not yet. There's one more question.
All right. Let's do it. Yeah.
And it's important one. I tell you, important because that's the question why my 4 children watch these deal talks every time. Okay. Because I'm asking experienced and super successful leaders like yourself whether they have an advice for them. And the question is, if you look back, to your younger self, is there any advice that you would give yourself, let's say 20, 30 years ago, that you should pursue?
Yeah. I think it comes back to how you look upon life, and that's, at least me, I've always been the why not person. You get some kind of challenge or some opportunity, and you're not sure whether you want to do it or not. Just go for it. Could I have told you when I was in college that I was going to be the CEO of a big private equity firm? Of course not. Not even close. Or could you? I ask you. Would you have any idea that you were, disrupting how those products are distributed in the world? Probably not. We barely knew about those industries. So, but the path there has been, going through doors that have opened or that you can push open, and trying things out. Because what I sense now with the next generation, is that they have so much information. They're going to try to plan their life early, and I think to have that maybe the entrepreneurial spirit even. To say, hey, sure, why not? I'll try that. And if it doesn't work out, we'll try something else, So keep that curiosity, that sure, why not kind of mind frame.
Love it. I love it, Christian.
What do you say? What's your advice if it was to my kids?
Yeah, look, my point would be is similar, but not the same. My point would be really, and this is something that I learned later from Henry Kravers, is the sky is not the limit. Yeah, I love modestness. I love, put your heads down, etc. But maybe I had a little bit too much of this mentality in the early days. Yeah, I think you have to be modest, but you can also at the same time strive for the stars. Yeah, and this thinking big and you will not become successful. And you kindly said you're disrupting the way private equity is distributed. You will not be successful if you do more of the same. Yeah, you have to think differently about things. And if someone wants to go into private equity, and many people ask me, I tell them it's probably not a good recipe if you just repeat the history. So if you go into private equity with a new view on investing, new themes, maybe even a new way to invest, do it. But you have to think very innovatively and think big, and the sky is not the limit. That makes you big.
Yeah.
Christian, look, almost done. What is missing is really my deepest and honest thank you. Thank you for the time. Yeah, it goes really is absolutely not without taking this for granted that you take the time here for us. Thanks for being with us, for being with the audience. It was a truly inspiring and insightful discussion. And to everybody who dialed in, thank you for your participation. Thank you for watching us, listening to us. Hand in if you have any questions or comments. More than welcome to take them on board and answer them and play them back to Christian. And stay healthy. And I hope to see you, of course, at our next Deal Talk, which is around the corner. Thanks a ton.
Thank you.